separate story now. The latest trend on the street is all about bringing hedge funds to the masses, and our next guest was among the first in the alternative space to broaden out to retail offerings. Joining us now is Henry Davis of Arden Asset Management. He's the president there. Arden manages $6 billion in assets under management and offers access to hedge fund investments using Arden's proprietary manager selection process. So, Henry, thank you for being here. The question: should all investors be investing in hedge funds? For so many years, there was this $1 million cap. People said, you know, hedge funds are for a certain selection of people out there, and now it's being sort of democratized. I'm assuming you're going to say this is a good thing, but the question is, are there certain investors who shouldn't be in this space?
I think probably, but it is a good thing because what it means is it's more choice. And more choice means there are more options and more ways for investors to potentially achieve their investment objectives. If your only options are long-only stocks and bonds, you're somewhat limited. So hedge fund strategies can expand the universe of what you're able to do. In most cases, you're going to be looking for a financial advisor to be making those recommendations for you.
Right. So, okay, so Mr. Bogle would say just, you know, buy an index. That's going to be your best shot. And in part, one of the arguments for indexes has always been fees. Fees, 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 and I'm assuming, and so my next question, in terms of all the hedge funds that then become available through your mutual fund, how does that work? What are the fees like?
Well, fees is an incredibly important part of the whole investment spectrum. So if you're building a portfolio that has some very low-cost investment products in them, such as indices or ETFs, you may be able to spend more of your fee dollars on active management. Active management typically is more expensive, and that includes hedge funds. So,
but what are the fees like?
Well, a typical hedge fund fee could be anywhere from 1.5% to 2% management fee and 20% incentive fee. In the mutual fund context, the fees are very much lower. The all-in fees typically are 2% or less, including all of the underlying manager fees.
What funds do you have access to through the mutual? I mean, so people look at like a Renaissance and they always say that's a closed, you know, they look at this amazing track record, but it's a closed fund, right? So who are we talking about?
Well, the recruitment part of this whole process is very important. And just to frame it, just so we clear exactly what we're talking about a mutual fund consisting of multiple hedge fund managers executing hedge fund strategies inside a mutual fund that any investor can invest in. In our program, we were able to recruit managers like D.E. Shaw, York, Jana Partners, CQS, Chilton, names that are very well known as hedge fund managers and have true hedge fund DNA. So this is a different animal than some of the liquid alts products that may have come before.
How difficult is it to get some of these guys to open up to the masses, and do we think trend line is going to go this way? I mean, do you think that David Tepper is ever going to open up, you know, open up to a mutual fund?
No, I do not.
You do not?
But I think the trend line is very clear. And what the trend line is saying, and what managers have recognized, is that there is a very large and growing pool of self-directed retirement assets. The individual investor is on the rise. And these investors are very underserved now in terms of the investments that are available to them.
You can listen to the best advice and say, okay, I need to diversify. I can't just be in this country. I'm going to go into emerging. I'm going to have, you know, things over there. But you're still going to be, those are all correlated. They're financial assets. To be able to have a non-correlated asset class, and I don't know how else you'd do it, because all bonds and stocks move the same way a lot of times, right? Financial assets. It'd be nice to have something, if everything goes south, it'd be nice to have something that was non-correlated to that. And this is the only way you can do it.
Well, you've just laid out the argument very nicely.
Really?
That's exactly what it's trying to do.
Non-correlated. Because you're always always long. And if everyone's
retirement, should have lunch and maybe
but if every single person's retirement plan in this country is long, and something happens, no one's going to be able to retire. So, I mean,
you put your finger on something very important, which is self-directed retirement assets. So that's 401k plans, IRAs. They now have 34 years of cumulative savings in that system. During that time, that coincides with a career. During that period, when you have a 401k plan, your objective is one thing. You want it to grow. It's growth. But as soon as you hit the retirement mark, your investment objective changes. You're not looking for growth. You're looking for capital preservation, and you're looking for replacement for income that you no longer have. And long-only stock and bond strategies may not be the best way to deliver capital preservation or yield-like returns given the current...
we got to run. Can a 401k plan, are there 401k plans that have access to your funds?
Yes.
They do. Okay. Thank you for being here this morning.
Get some non-correlated assets in your